Imagine standing on a busy street and everyone suddenly turns around and walks away from the signs of economic growth, despite headlines saying the economy is growing. That's what's happening right now in the US. The data headlines still point to positive growth, but the confidence of everyday Americans has crashed, and it's happening faster than most people realize. In the final days of January 2026, a key economic gauge called the Consumer Confidence Index plunged sharply, hitting its lowest level in more than a decade. In January, this index fell from about 94.2 to 84.5, a drop of 9.7 points, the lowest reading since 2014. Consumer confidence isn't just another number. It's a snapshot of how families feel about their jobs, income, spending power, and future financial prospects. When confidence is high, people spend more, businesses invest more, and the economy hums. When it collapses, the opposite happens. Spending slows, hiring stalls, and uncertainty spreads. So why did this plunge happen now? According to economists tracking the data, the dramatic drop wasn't caused by one thing. It was a combination of rising prices, uncertain job prospects, political tensions, and fear about what comes next. Here's how the index breaks down. People's short-term expectations about income and job prospects fell to 65.1, well below the threshold often associated with recession signals. The percentage of consumers who think jobs are plentiful dropped sharply, while those who believe jobs are hard to find increased. That means confidence in the present situation and future expectations both deteriorated together. This is dangerous because when people don't feel confident about their finances or job prospects, they tend to spend less, save more, and postpone major decisions like buying a house, starting a business, or investing. But what's particularly striking about this drop is that it cuts across income groups, age brackets, and regions. Even households with steady incomes reported growing concerns about basics like groceries, utilities, rent, and healthcare costs. The consensus among many economic watchers is this: the headline economic numbers, GDP growth, stock markets, corporate earnings, don't match what people feel in their daily lives. That gap between the data and public sentiment is what makes this confidence collapse especially worrying, and why many people are suddenly questioning the strength of the US economy. The sharp drop in confidence didn't occur in a vacuum. There are several overlapping forces pushing Americans toward pessimism, even as some economic indicators remain positive. 1. Rising costs of essentials. Prices for everyday things, groceries, gasoline, utilities, continue to outpace what many households feel comfortable with. Even if inflation has cooled from the heights seen in recent years, it's still above where many want it to be. Persistent price increases create constant friction in household budgets, forcing families to choose between everyday needs rather than discretionary spending. 2. Job market strain. Another factor pushing sentiment down is the labor market. While major layoffs haven't skyrocketed, hiring has slowed significantly. Instead of a vibrant hiring environment, the US is experiencing what economists call a low-hire, low-fire situation, meaning more people are holding onto jobs, but new opportunities are scarce. It's keeping employment technically stable, but not creating the broad optimism people need to feel secure. 3. Policy uncertainty and political pressure. Consumer confidence surveys regularly include mentions of politics, tariffs, and policy decisions, and in recent months, they've become top concerns. Trade tensions, changing tax policies, and ongoing debates over healthcare and insurance have made many Americans uneasy about what might happen next. 4. Disconnect between markets and Main Street. One of the most confusing aspects for many people is the gap between booming markets and struggling households. On paper, GDP growth and certain sectors of the economy look strong. But if workers aren't feeling the benefits, because wages aren't keeping pace with rising costs, then public sentiment will lag. That disconnect is one of the core reasons confidence has collapsed. Something that looks strong at the aggregate level doesn't feel strong on the ground. In short, rising living costs, slow hiring, political uncertainty, and a disconnect between economic headlines and everyday experiences combine to push confidence to levels not seen in more than a decade. A collapse in consumer confidence isn't just a statistic. It quickly translates into real-world behavior. When individuals and families doubt the economy, several predictable shifts happen. 1. Spending slows down. Consumers begin to hold on to their money rather than spend it. Big purchases like cars, appliances, home renovations, or vacations get postponed. This weakened spending shows up later in retail sales figures and corporate earnings reports. 2. Savings rises, but not always by choice. Sometimes people save more because they're worried, not because they can. That means less cash flowing into the local economy and more financial stress for families just trying to stay afloat. 3. Hiring becomes tighter. Businesses monitor consumer sentiment closely. When confidence drops, companies may put hiring plans on hold or slow down expansion, reinforcing the weak hiring environment that helped cause the problem in the first place. 4. Psychological impact. Low confidence can become a self-fulfilling cycle. When people feel uncertain about their economic future, they tend to make more conservative decisions that slow economic momentum even further. This combination, reduced spending, cautious hiring, and increased saving out of fear, can create a feedback loop that slows growth more broadly. What begins as declining sentiment can evolve into slower economic performance if not addressed. Even though this confidence slump is worrying, it's not necessarily a sign that the economy is collapsing. There are signs that not all is lost. 1. Continued overall growth. Economists point out that certain parts of the economy, including consumer spending in some sectors and technological investment, are still growing. There's a possibility that confidence could stabilize if inflation continues to moderate and hiring picks up. 2. Policy response can change expectations. When policymakers focus on affordability, job creation, and consumer protections, confidence can begin to recover. Historical data shows that sentiment is sensitive to clear, credible policy direction, especially around jobs and prices. 3. Individual financial preparedness. For households, the best defense against low confidence is often personal financial stability, such as savings cushions, diversified income streams, and debt reduction. While confidence may fluctuate, individuals with strong personal finances tend to weather the broader economic storms better. Ultimately, the decline in consumer confidence is a warning, not yet a crisis. It signals that many Americans feel disconnected from the positive economic headlines and are bracing for tougher times. Analysts, businesses, and policymakers are watching closely because restoring confidence is key to sustained economic momentum. In the next weeks and months, all eyes will be on job reports, inflation data, and consumer behavior to see whether this slump deepens, stabilizes, or begins to reverse. You might think only low-income workers or people struggling to make ends meet are losing faith in the US economy. But recent data reveals something far more striking. Even Americans in high-paying jobs are beginning to doubt the economic future. This shift isn't just psychological. It's a structural signal that something deeper is happening in the US economy. Why is confidence eroding across income levels, ages, and professions? And what does that mean for the rest of 2026? 1. Confidence is falling even among high earners. Recent reporting shows that Americans earning more than $100,000 per year are rapidly losing confidence in the economy, and they're doing so faster than middle and low-income households. This shouldn't be ignored. Historically, higher income earners have more financial stability, stronger savings, more access to credit, and often careers that are less immediately affected by price changes in everyday goods. Yet even these groups are reporting heightened concern about job security, future income, and economic prospects. This is a serious signal. When the top third of earners start to lose faith in the economy, the effects ripple outward, weakening consumer spending not just among those with limited cash flow but even among those who traditionally help drive big-ticket purchases like cars, homes, and major services. 2. Labor market anxiety, steady but stagnant. One of the core drivers of this lost confidence is the US job market. While unemployment remains relatively low on paper, the reality beneath the surface is one of stagnation rather than expansion. Job gains in 2025 were significantly lower than in 2024, less than 600,000 total for the year compared with over 2 million previously. Many workers describe the labor market as low hire, low fire, meaning fewer new job opportunities and companies hesitant to expand hiring due to uncertainty. The result? People feel stuck. They may not be losing jobs en masse, but new opportunities aren't materializing either. That uncertainty directly affects confidence because even employed workers begin to wonder, what if my job is next? Or will I ever get a better opportunity? This isn't just anecdotal. Sentiment surveys show that the percentage of consumers who believe jobs are plentiful has dropped sharply, while those who feel jobs are hard to get has risen. 3. Inflation lingering below the headlines. Although headline inflation numbers have eased from post-pandemic highs, many Americans still feel the pinch of rising prices every day. Groceries, gasoline, rent, and healthcare costs continue to take a larger share of monthly budgets, and that's creating a sense that prices keep rising faster than wages. When households feel like they can't get ahead financially, even if broad inflation data moderated, confidence drops. This is especially true when prices rise for necessities, while wages stagnate or grow slowly relative to costs. Even shoppers who once felt secure are now saying, in effect, it doesn't feel like we are better off. 4. Politics, tariffs, and policy uncertainty. Another element eroding confidence is policy uncertainty. Tariffs, especially on key imports, have raised costs for businesses, which often pass them on to consumers. Potential future policy changes around taxes, trade, healthcare, and corporate regulation have become persistent sources of anxiety in surveys. This uncertainty isn't just about economics. It bleeds into personal financial planning. People delay purchases like cars or homes when they feel unsure about tax policy, trade deals, or future regulation. That delayed spending further weakens economic momentum, creating a feedback loop where feeling pessimistic actually makes the economic situation softer. 5. The disconnect between markets and Main Street. One of the most confusing things for Americans right now is the gap between macroeconomic numbers and everyday life. On paper, GDP has grown, unemployment rates remain low, and certain sectors, especially tech and AI investment, continue to expand. But those headline figures often don't touch the lived experience of most workers and families. Wages are not rising fast enough to match costs. Job opportunities are stagnant in many industries. Daily expenses like groceries and rent still feel increasingly expensive. This disconnect creates a psychological effect known as economic dissonance. People don't feel the economy is healthy, even when some metrics say it is. That dissonance weighs on confidence, dampening spending and planning. 6. What this means for 2026. So, what does all of this add up to? A few key takeaways. Slowing confidence can become self-reinforcing. If people spend less because they feel uncertain, economic growth can slow, which then reinforces the pessimism that started it. Businesses react to sentiment, not just numbers. Lower consumer confidence often leads companies to delay hiring or investment, which further slows growth. Short-term feelings matter long-term. Even if fundamental economic indicators remain solid, sustained low confidence can weaken the economy through reduced consumption, hiring restraint, and delayed investment decisions. In other words, how people feel about the economy now has real power to shape how the economy performs later. Confidence isn't just a headline statistic. It's a reflection of millions of individual decisions about spending, investing, and planning. Right now, those decisions are increasingly tinged with worry. And until that worry begins to ease, whether through job growth, inflation relief, or policy stability, consumer confidence may continue to moderate.